Today I'm going to share with you a case of someone who has more than 600,000 in his investment portfolio. I'll be showing you details, so don't worry about it. And in addition, this story is very interesting because he came from a low income background. So with that, we can all break through in terms of mindset. What can be done and what can be built regardless of where we start with. So if you're curious to find out, continue watching. Hi guys, welcome back. Without further ado, let me share with you what he's actually written to me. Thank you. I've been following your YouTube channel for years and really appreciate the content you put out. It's helped shape my investment philosophy and strategy. I'm always glad to hear feedback like this, and hopefully I've also inspired you to make better changes for your own financial future. Some background of him. He's currently a single, turning 50 this Monday, and he actually came from a poor family background. Single income family with huge medical burden. So for his story, he's actually started with pocket money, 20 cents only. Right now I give my son $2, of which bowl of noodles 10 cents, drink was 10 cents. So to save up 50%, he actually drank water from the toilet tap. I think this is very humbling a story. Even for myself now, I also still drink from water tap sometimes and refrain from buying a canned drink whenever I bring my family to the food court or to restaurants. I very seldom order alcohol, so you realize that my expenditure is actually relatively low as compared to many friends in my age group. But back to his story. Despite the challenges, I've managed to finish my polytechnic studies, went to NS, started working, and he's actually done a part-time degree on his own. Times were tough and his father passed away shortly after he went into the workforce. So his first paycheck, $1,550 only. And despite not earning much in the first 5 to 10 years, he never stopped learning and never stopped upgrading his skills, and that's why he's actually managed to earn progressively higher and higher income. He's even switched industries, and right now at the age of 50, his monthly salary is close to $10,000. So if you think about it, 7x of salary, correct? Starting pay, $1,500, now $10,000. So regardless of where you start, I think this hopefully inspires you that you build the right experience, build the right value, you can earn higher and higher income. Nowadays in media, there's so many fresh grads that mention, they want a high starting pay, they want to retire by the age of 30. But again, things need time to build what, correct? Your income potential is based on your experience and your ability to provide value to your organization. So sometimes it takes time to build all this up. So don't rush it, don't have the wrong expectations. And Jack Ma has even mentioned, especially when you're young, focus on learning. Learning is more important than your first paycheck. If you follow the right company, right leader, you would learn faster, and over time, it will be more rewarding. So hopefully these are important messages. And also if you are right now graduating from Polytechnic, don't worry, today's story might show you a blueprint on how to grow your income and become financially successful. So back to his investment portfolio, and luckily, he shared details. In the start, he never knew too much about investing and financial literacy. He's always been taught that investment can be risky and he should save as much money as possible. For myself, I'm quite lucky. My parents have always bought shares, and I can see from afar the principles of investing. Sometimes our family teach us one thing and we may need to unlearn some things here and there. And the message I'd like to share with you is your first 100,000 is a pure savings game. But beyond that, it becomes an investing game already. So if you want to compound your money faster, you need to watch videos like this to learn about investing. If you agree, smash the like button. If you haven't started investing, do so today. I'll leave links below on where you can follow on. Back to his story again. He started finding out more about investments when he started working with SGX and found out more about the investing space. That's when he learned about regular savings plans, and his first passive investing was $500 a month with OCBC BCIP. Then gradually he increased it to $1,500 and then continued for several years. So OCBC BCIP is one solution to buy stocks regularly from Singapore's exchange. You can also buy Philip's Share Builder plan if I'm not wrong. For myself, I'm also a big advocate of regular investing. I build that for private clients' portfolios. And you can see, right now, in total, I have more than 450,000 committed from private clients for regular investing. That's quite a big amount, correct? $5 million in a year of DCA. So as always, if you need investment advice, if you want retirement planning, look for my links below. I can help you on a fee-based, one-to-one basis. So thank you very much. Let's dive back to more from his sharing. The good thing is that this regular investing has forced him to amass a good amount of savings, enough to go for premier banking service. Fantastic, huh? Then around 3 years ago, he decided that passive investing into STI ETF does not seem to pay off much. He rotated towards US ETFs and then subsequently to individual stocks. He bought his first share of CSPX, which is a London-listed Irish domiciled S&P 500 ETF, and then he began to concentrate into it and VWRA, which is a world ETF. Then after investing more than 68,000 US into these two ETFs, he decided to pivot more towards individual stocks to gain more experience and once he had more confidence. I think this is a very common path for all of us. At the start, we take something more slow and steady. Then once we realize we understand risks, have tolerated ups and downs before, we are curious about what can potentially increase our investment rate of return, correct? So I've been through this journey myself. Then I started to look for individual stocks. That's where some hard lessons come about because we all make mistakes. This is part of the Dunning-Kruger curve. When we start off, we think we know a lot of things. What? I want faster returns. Chong, take leverage. But then you get burned, then you realize, hey, maybe cannot rush things. Then you have a bit more humility and you start to see things on a bit more balanced basis. So hopefully you're also on this learning path. And as always, Mr. Market is a very humbling machine. Whenever we think we know it already, we start to get hiccups and we start to see some mistakes coming. And main message again is if you haven't started investing, start right now. Look at my links below to get started. If you're looking for a good platform to invest right now, check out Longbridge. Longbridge is licensed in Singapore and they've appointed DBS Bank as custodian for clients' monies. They are currently Singapore's only brokerage platform to offer lifetime $0 commissions and $0 platform fees for US, Hong Kong and Singapore stocks. Particularly for Singapore stocks, I believe it's one of the cheapest right now in the market, as you can see in this comparison table over here. And for whichever stock you are interested in, you can even check out their details with the tools that Longbridge provides. Access everything on your mobile phone and in my opinion, simple to use. And in addition, in the bottom right hand side, there's actually Pod AI, which integrates real-time data specialized in providing finance and economic news to you. All this absolutely free once you have an account. So if you're keen to sign up today, you can receive up to $800 worth of sign-up bonuses. I do have an exclusive $18 cash coupon when you use my links below. They have a campaign now that lasts till end of September. You not only have this 6% cash booster, with my links below, you get an additional 6%, which means 12% booster of interest for 90 days. So go and maximize it. In addition, when you do relevant trades and qualify for its highest tier, you can get for yourself shares of Nvidia, Apple, and Google. So what are you waiting for? Sign up today with Longbridge using my referral codes below, and I'll see you inside too. And let's get back to more details that he has shared. Currently, his portfolio size is about $668,000 with unrealized gains of $292,000. Wow, so 78% up. Imagine you put that into fixed deposit. How many years do you need? 30 years? Can't be, right? So investing indeed, if you do it properly, is your way to build wealth. Don't keep just saving money. You need investments to fuel your next leg of growth. Then in terms of cash, currently he has $140,000 in OCBC 360. And even though he's been investing gradually per month, he wants to still deploy more cash, especially when markets go bearish. Currently, his portfolio is split into 5 areas: London-listed ETFs, which is CSPX, and the VWRA. And he stopped that actually because he feels that growth is not as good. This one we'll debate a bit later. These broad-based ETFs are very good long-term buy and hold vehicles. They are tax efficient. You do save on dividends. Estate taxes also, you avoid complications rather than owning US listed directly. Next part, he has US listed stocks, mainly tech stocks. Usual suspects, Google has skyrocketed. I do own a bit of Google also because he's familiar with Google's offerings and he's bullish on Tesla. And that's because he believes in Elon Musk, although there are haters out there. I don't have Tesla, but Tesla, as you can see, has skyrocketed recently also. So he believes in them and he believes also in SoFi. I do know in YouTube community, many have covered on SoFi, especially US YouTubers. But as always, make sure gut feeling wise, you know the business. Don't just watch or don't just read because it's deeper than that. And looks like he's done research deeper as what CEO Anthony Noto has mentioned on how he'll be growing SoFi. So good for him. At least he knows what he's invested because there'll be bad periods, correct? Hong Kong, he's also started buying into China recovery story. He has Alibaba, which has skyrocketed. JD, Meituan as latest investments. Meituan has stagnated a bit, but as always, there's going to be hits and misses. As long as your wins are way bigger, you realize you grow wealth very quickly. So Singapore-wise, for the last 2 years, he's topped up to SRS for tax relief. He's bought CFA REITs, which is actually one of the more popular REIT ETFs, reinvesting all its dividends. Crypto as his fifth space, he has Bitcoin and holding long term. So if you're curious to find out the list, let me show it now to you. This is the entire list over here, and I'll broadly comment, not on individual names. Firstly, what I realized is there's no over concentration on any stock, which is good. You know, even Warren Buffett has trimmed down Apple. So luckily there's nobody that's like 50% off the weightage. It's not like, 50% to Tesla, all in kind of perspective. Because there's ups and downs, and we don't want any mistakes to destroy our entire retirement game. Investing again is just a vehicle to get to your retirement. Then the second thing I observe also, there is no overly long list. I've seen before on private clients list of 30, 40 names, and my first advice is, hey, are you sure that the research is thorough, or are you taking advice too quickly what to buy? If that is the case, it's very difficult to do stock investing. You might as well go broad-based really once you have like 30, 40 or even 50 names. So this list looks tight. This list looks like something with strong conviction, which is actually at the foundation of good investing. I've always been saying also that if you rush to buy something, you also rush to sell when times are no good. So as always, slow down your buying process. It will help you in the long run. It's like, dating. If you get to marriage too quickly, you realize that, hey, not too sure. But if you date sufficiently long, you realize you have stronger conviction when times are tough. So these are the good parts. The not so good part is I'm not too sure how to use this portfolio for retirement. Is there a selling strategy or not? Because so far from 2022 to now, stock markets, especially US, has been on an uptrend, correct? Will this continue indefinitely? Because if we see in the period from 2008 to 2010, even S&P 500 was bearish. Very difficult to make money. So we're not sure if this has been battle tested. And beyond that, I have a second thing that caught my attention. Is there a plan to exit on US stocks? Because if this grows, there's going to be estate tax that's going to be significant. All US listed assets can attract 18 to 40% in estate taxes, even though we are Singapore based, that will still be taxed away. So if you build a US stocks portfolio, once it gets too big, this becomes a big worry. Especially when we talk about retirement and eventually we'll all go to heaven one day. So keep a watch out. I think at some point, this stock investing in US might not make sense. So let's move on to other things he's shared. CPF wise, he's paid off his property already. Fantastic. OA 92,000, SA 245,000. So this of course means that he has more than full retirement sum. Even surpluses that he could withdraw out. And so far he's been a good investor. Maybe investing some of his OA surpluses in future would appeal to him. So he next mentioned, hi Josh, it'd be good if you can give me some suggestions on retirement. Since he's kindly shared his story, let me share with you some things that I would like to ask also. The first thing is the insurance portfolio well built or not? What he shared to me, yes, at least there's medical insurance, at least there's personal accident insurance. When we go older, my own mom, she's tripped before on a curb and fell and bruised her face. So when we get to older ages, personal accident actually becomes a lot more useful. Then also the next part is there long-term care insurance? Long-term care is if you become disabled. Upgrade your own CareShield Life. Right now, CareShield Life covers from age of 30. And when you buy early, your premiums are way cheaper than you buy at age of 50. So all these long-term care benefits are to ensure you don't deplete your own retirement pot. Especially if you become disabled, you need to hire a maid, you need to go to a nursing home. These extra costs can inflate, and you want some insurance to provide you cash flow. Then beyond that, I'd like to circle back the retirement game to this 668,000 investment portfolio. How to build cash flow for me, correct? Yes, there are Singapore listed CFA ETF, but there seems to be a slight problem when it comes to taking out from it. It's a bit like investment property. When you buy a new launch property, it becomes like a capital gains game, correct? Because you don't know what is the cash flow. Or sometimes, even after it's built, you rent out, you realize you're negative in cash flow. It doesn't help in your retirement income streams. So all you're hoping is that the property price goes up, you sell out, you get a capital gains again. So it becomes a capital gains, especially when we look to invest into overseas stocks like US stocks. In some extremes, that could put us in a situation whereby we are asset rich and cash flow poor. So if you think about it again, retirement is not a how much assets, how much cash you have. It's a cash flow game. If you have cash flow of $5,000, you realize you are usually financially free. So here's what I would suggest. Although CSPX and VWRA are slow and boring, they are actually the easiest solution to sell off when you need retirement funds. Consider rebuilding them, because in retirement, it's not the same as in working where we're just trying to build. In retirement, we have this problem, which is the sequence of withdrawal risk. What it means, if you look at this diagram, of 2 retirees with 100,000, the average return is the same for 15 years, but when the first one sees market go up over the first few years of withdrawal versus the second one, market goes down in the first years of withdrawal, you realize that at the end of 15 years, the outcome is very different. It tells you one thing. When it comes to retirement and we want to take up money, if the stock market is bad for a few years, like in 2008 to 2010, you realize that any withdrawal will impact the portfolio severely. If you're broad-based and diversified, you realize that the swings are lesser. Withdrawals will not impact the portfolio that much versus an individual stock. We've seen before Google share price drop by 30%. We've seen before Tesla share price drop by 50%. Tesla right now looks good, but for this period, as you can see over here, it looked gloomy, correct? A minus 50% at some stage. So for stock investing with volatility, it becomes a lot harder to withdraw. Broad-based again is slow and steady, helps tremendously, especially if you need to plan selling. So that's what I'll suggest for him to focus on. And maybe for you also, especially if you're thinking about withdrawals from your investment portfolio. Think about it, and if you have questions, leave in the comment sections as always, and I'll see you in a future video. With that, I'd like to introduce you to this previous video of someone who's from a lower income situation also. Hopefully this has some nuggets of wisdom and is an interesting topic to you. I'll see you there, and I'll sign off from here. Take care as always. Goodbye.